What is the yield curve, and why do analysts reference it so often? If you follow the markets, you've probably heard analysts referencing this before. By the end of this video, you'll know what the yield curve is and why it's so useful. Wednesday Wisdom Nuggets brought to you by... Open a stock trading account today with a trading platform that makes share trading easy. Our experts even tell you what and when to buy or sell. Before we get into the advanced stuff, let's break it down. A yield refers to how much an investor receives as payment from their investment as a percentage of the value of their total investment. For example, to calculate a bond yield, an investor would calculate the interest payment received as a percentage of the market value or price of the bond. The yield basically tells you how much money your investment is generating. Therefore, if you take a bunch of bonds with different maturities but equal risk and plot their yields, then you get the yield curve. So, we have bond yields on the y-axis and bond maturity on the x-axis. What's bond maturity? This is simply how long before the bond expires. Bonds operate a lot like debt and at some point need to be paid back. Watch our short video on bonds to learn more about bond maturity. You can use any combination of bonds with different maturities to plot our yield curve. But when analysts refer to the yield curve, they are usually referring to the treasury bonds which are paid by the Kenyan national government. So why do analysts and investors care so much about the yield curve? One of the main reasons is because of its shape. The actual shape of the yield curve can provide insights into the future economic outlook, growth, and even inflation rates. As you plot the yield curve, you realize it may have different shapes. It could be upward sloping, also called normal, downward sloping or inverted, or flat. An upward sloping yield curve means that lower yields have shorter maturities and longer yields have longer maturities. In other words, investors who have longer dated bonds receive higher interest rates. The opposite is true for an inverted yield curve, where investors who hold longer dated bonds receive lower interest rates. While for a flat yield curve, this means that longer and shorter dated bonds receive relatively equal interest rates. We'll go over the reasons for these varying shapes in another video. But what do these shapes tell us? Or what insights can they give investors? When the yield curve is normal or upward sloping, investors tend to believe that economic expansion is on the horizon, while an inverted yield curve is interpreted as an economy approaching a recession. A flat yield curve, usually seen during the transition between a normal to an inverted curve, is typically an indication that investors and traders are worried about the macroeconomic outlook. But why do these shapes seem to have fortune-telling abilities? To know the why, you need to understand how this all works. Keep an eye out for our next Wednesday Wisdom Nuggets. Subscribe to this channel to make sure you don't miss a video. That's it for today, and don't forget to download the AIB DigiTrader app and become an investor.